Hello and good afternoon. We're going to do a macro review of the year 2007, and we're going to look at some interesting data. Year to date, global positioning, global fund flows, the VIX long term, the S&P 500 long term, and then some market profile in a very long term view. So in front of you, you have the performance of the major benchmarks around the world. In this column, you can see the return year to date on dollars, on local currency. And here you can see the return year to date in US dollars. So we can see how Nasdaq had a good year, 21%, followed by the Dow Jones, Bovespa, Brazil, and then the S&P 500 with an 18%. The best performing index so far in Europe in local currencies is Italy, followed by Switzerland and Germany. Spain had close to near 9% year to date, and the Euro Stock 600 about 7.6 year to date. In local currency, if we measure this in dollars, we can see that the return is much higher because the euro moved from 1.4 in the beginning of the year to 117, I think it traded today, 118, I believe. Asia did quite good, especially the Hansen with a 30% year to date in both local currency as well as in dollars, similar to the Nasdaq. Okay, so having this into consideration, I want to review fund flows. Here we have global fund flows for mutual funds reporting to Lipper, right? This data we're going to review is based on billions of dollars of flows. It means redemptions from the funds or liquidations, right? Surprisingly enough, we have in the United States about $200 billion that exited, right? And this includes bonds, equity, money markets, and other type of assets. We could see them here: bonds, other assets, right? Mixed assets and other assets, equity, and money markets. It's important to notice that in equity, we saw close to 70 billion exiting the mutual fund industry and went into the bonds. At least the bonds, in my opinion, it showed that it had an inflow of 240. So I believe that some of this equity ended up going into bonds, which currently is not a great performing assets. Surprisingly enough, money markets, with the dollar getting weaker versus the euro, got an outflow of 327. This is a big part of this, right? Of this 200 here. The equities in Europe also experienced a $5 trillion outflow. This outflow comes especially from UK, that had a minus $4.5 trillion. I mean, American trillions, right? This is 4,000 billions, okay? So it's important to notice. Money market experienced a 700 billions inflow, right? You can see here how the money market exited 300 million and went most probably in money markets in Europe. So this is mostly based on European equities. I mean, in the euro, right? Which also could affect European equities because first they are transferred to euros and then could probably go into equities. But this number here is huge. It's especially from the UK. In Asia, we saw an inflow of equities. That this makes sense because the returns, as we saw here, are positive year to date. The bonds also got a small inflows of 30 billions, and then other mixed assets and money markets were around between outflows of 15 to 20 billions, right? Globally, equity saw a huge outflow, especially coming from the UK, you can see. And then bonds saw a big inflow. This comes from a little bit in Asia, and a big part of this in North America. And there's 92 billions coming from Europe. So this is the view, right? This is what happened year to date based on Lippert data. That is probably one of the best data to analyze fund flows around the world. And now we're going to review what the managers thinks or investment firms thinks what is the ideal model portfolio allocation. So let's go to the world, right? And let's pick equity. Okay, we're going to only analyze the equity. We don't want global balance or global bonds, only equity. So to be fair, let me tell you what this poll is. This is a poll asked every single month by Thomson Reuters to global asset. It's a global asset allocation in a monthly survey of recommended model global portfolio allocation from many of the world's top investment firms, right? Is collected from companies based in the United States, continental Europe, United Kingdom, Japan. The global totals display a straight average of the region allocation. It's not weighted, right? It's important to notice that. So let me show you what is happening. This is the recommended global model, right? Portfolio. These managers invested in US and Canada. They want a 38% for this. It has been coming down recently, but it had increased a little bit in December last year, and now it keeps decreasing. This is what the world thinks of investing in US and Canada. Now, if we go to the United States, what managers, right? US investment firms, what they think about investing in the United States, could go lower. You can see how we see a decrease on the investment market share. So here they were talking about the 70% of their portfolio, and now they're talking about 60%. It has been going down. If we ask them about what they think about European equities, right, we get a different view. You see, they keep seeing European equities more and more attractive. So we could say in 2015, they were talking about a 14% allocation, and now they're talking about a 22. This is a huge ramp up from April, May this year, from 16 to 22%. This is what they think American managers think about Europe. So now let's ask European managers, right? Let me go to the US. So these are European managers investing in the US. Last year, after the election, right, November, they saw a drop. Then they got the high of the year in January, right? And then has been decreasing little by little until July. But we can see how it ranged from 36 to 38 with a spike here in September 2016 and another one in the beginning of this year. So this is asking European managers what they think about US companies. To the contrary, if we add European managers what they think about their own equities, they're under allocating. So from March 2016 to April 2016 to today, we see almost a 10-point drop in percentage of allocation, which differ from what American managers are thinking about European companies, right? We need to notice that European companies has underperformed US companies in local currency. But if we change that to dollars, we can see how they did quite good. My question here is, why American managers are more positive about Europe than even European managers, right? So if we go to Japan, Japanese asset management firms, right? Recommended model portfolio from Japanese asset management firm. We can see that they keep a big percentage of the assets in local funds, right? 46%, 30% in Canada and US and Canada, and 8% in Europe. Let's show what they think about Europe and how it have changed. About Europe, barely have changed during the year, with a maximum of 50% here in May to a low of 5% in April 2016. But there are a bit flat as well in North America and Canada. I mean, US and Canada, right? Increasing a little bit on October to all-time highs. Let's say not all-time highs, but from this data, very much the highest allocation ever was here in October, right? If we ask United Kingdom managers, right, firms registered in the United Kingdom, and they of course overweight the United Kingdom, and we can see how even though they got huge outflows, they're increasing their view or their model allocation to the UK. But let me show you what they think about Europe. As well as American manager, during the year they have increased their allocation to European zone, to the Europe zone, right? This is only equity. We're not talking about bonds nor balanced portfolios, only equities. And if we show US, right, we'll see that they have considerably decreased their allocation, model allocation, to the US. So the question here is, why European managers are negative about their own equities, American managers are positive about European and United Kingdom asset management firms are positive about Europe, and lately got very bearish, or they lower the recommendation for US and Canada's equities. This is something to notice. I don't have the answer. If you have a view, just tell me, because it would be great to share. This is an open-ended question. There's no one that I think that will know the answer, but it's a great thinking process. I believe the market is right. I mean, these are opinions, but this is the real market. I mean, these are mutual funds, redemptions, and liquidations. This does not lie. I mean, equities this year, with a terrific year on the indexes in the US, have experienced outflows. European companies, I mean, I could have the breakdown of this, but even if we remove 4.8, right, from 5.1, we still see negative in European. So both of the main allocations for mutual funds, Europe and and Americas, they had been seeing decreasing billions of dollars on their allocation, but getting positive from investment firms, right? So let me show you again, United States, American firms view on Europe in the long term. You can see here they have increased, right? And they are lowering the exposition to US. And in the other hand, European asset management firms, they're increasing to the US and decreasing to Europe, contrary to they're taking different positions, right? Now let me go to something more tangible. This is the VIX. We could show you in a very long term. This is from 1990, right? The low, the historical low, it was this day here, or this week, right? With a 9 close, I think it's a 8.97 low. I believe, I could be wrong, and if the market is there to prove me wrong, that this could be a multi-year low. It could prove me wrong in the next few quarters, but this tendency could be similar to what we saw in 2005 and 2006. If I zoom in on this, right, we can see the lows here in 2005 and 2005. Remember, the market in 2006 was not bad. It had an important spike in volatility here, right? But the low was marked here in 2006, quite before the financial crisis. Then in 2007, volatility already spiked before in June, July, right? This is what the first Bernstein hedge fund blew off, right? This is the second one, I think, but before the financial crisis. So volatility already increased, and then of course became the financial crisis with Madoff and Lehman Brothers, and this is what happened to volatility. So we can see how even in 2005 or 2007 to the end of 2006 and the beginning of 2007, volatility was quite low before it started increasing. I'm not saying this could repeat this year, but I believe this volatility is very low. And I see some patterns here that every time we trade higher, we come lower, and the triangles are very small, forming very small triangles, similar to what we saw here, right? It just stayed for a couple of weeks and then came down. This is my idea. And then I want to show you the market profile. 1 second, let me show you. So what you have here is a market profile in a quarterly basis, right? So the volume, it shows the volume printed for the S&P 500, where the first quarter we have a B period. We saw high consolidation in the beginning of the year. Then we created this low volume area and went to explore new highs. The following quarter, we came down, almost double bottom here with at this low volume area, got rejected, and we got a 3 E pattern. You could see this is like an E pattern on the volume profile, consolidated for a long time in this node, right? And then again explore to all-time highs. Let me show you again the candlesticks. So you can see here, like, this low was respected, this low volume area was tested and then went higher, and after huge consolidation in this area, 24, let's say 24.75, we could say that, we kept exploring higher prices. We consolidated here 25.78 high volume node for a long time. You can see the first time we explore this price level was in June, right? And sorry, in October, until almost the end of November, when we broke out, and then we went off the races. Right now you can see we're trading a bit lower from all-time highs. I'm sorry, now is all the data here. You can see we reversed a little bit from this time exploring prices higher, and then after small retracement, not taking these low volume nodes, right? You can see we went much higher, and now we're trading at all-time highs, very much. We could do this thanks to window trader in a monthly basis. So I could, let me remove the candlesticks so that way it's clearer, and we can analyze how the auction worked in a monthly basis. I leave the chart here for you to take a view. My long-term view on the market, let me put this in a monthly, right? We do still have room to go higher, right? And let me see if I could load more data on a quarterly basis. So yes, this price increased, right, from almost 10 years is quite significant, but I believe, and I'll show you now, that we could be still in a longer bull market than what we see right now. It would be healthy for the market to retrace, right? At least a few percentage to find buyers lower, right? To see and to test if there are buyers lower. But let me show you what I mean. The market from the beginning of the 70s to the end of the 70s, right? The performance was only 78%, 73% in 10 years, right? Oops. From the beginning of the 70s to the 90s, right, to the end of the 90s, was 400%, right? If we compare that to from the low to today's high, right, or from this period's high, is 300% in about 10 years, right? And this is 20 years. But if we modify this from the 80s, from the beginning of the 80s to the end of the 80s, is 280. Okay, so in 10 years is not something outrageous. And if we go to a really bull market from the 90s to the all-time highs before the dot-com bubble, this is 377, right? Just pure valuation of equity markets in the S&P 500. If I show you Nasdaq, it will differ. I mean, actually, I'll show you Nasdaq in a bit. And this was without the inflows and the quantitative easing from the central banks around the world. So in 10 years, the market did a 377%. In 10 years from the low, right, to the all-time highs of today, we have 300%. But this came without quantitative easing. Yes, a great bull market, but without quantitative easing, having already made 280% 10 years prior to that, right? So if we are going to really start a bull market, there is room to go. Yes, prices, PEs and so on, it's not cheap. And European equities seems to be cheaper than American equities, even though European fund managers like American equities, and American fund managers like European equities. So let me show you Nasdaq, right? So if I put Nasdaq in a really long view, right? We'll have to go quarterly. Let me see if I have more data. I don't have more data. Right? From the lows, this is the NDX, right? From the lows, from the financial crisis to today, we're overextended this month. You see, this quarter we're overextended. That's why FANG stocks and so on, sometimes they get a lot of volatility. We are overextended. So info line from the low to the high, this was 500%, right? In about 9 years. Info line from the beginning, from the 90s, right, to the maximum, to the peak in the year 2000, it was 2000%. Let me see if I have more data here. Let me see. Let me see if I put yearly data. There's no more data. Right, we could do a similar exercise with the Dow Jones that have a lot more data. Let me show you in the Dow Jones. Right, so we go quarterly. We give you historical data. So we could do the same exercise. From the low in the financial crisis to today, you could see how we are overextended, right? Let me remove this. On the regression channel, right? And the quarterly lines, let me see, info lines from the low to the high, we did 280%, right? From the financial crisis to today's high. However, info line in the 90s, right? From here, say the end of this, to the highs in the year 2000, we did 300%. And we did 300% similarly from, let's see the high, coming already another 190%. Of course, if we do this, in 20 years, we did 1,000%, right? Of course, from the 90s to the 2000, it was the internet bubble, the market were on fire, and so on and so on. But quantitative easing was not present. There were other laws. I agree. We could go back into the books and say what fueled these interest rates and the Glass-Steagall Act, and so on and so on. Yes, but it was not quantitative easing to the way that we have experienced in this downturn, right? So this is getting a long video, so I'm going to stop here. This is some of the questions we reviewed today on the Q&A for RandBots. And so far, I want to show you, to conclude, I want to show you how our option model is doing. Okay, so here you have our option mini model, right? This is a leverage model from our option that we are about 36% year to date. This includes the subscription cost and trading cost, right? Our option model this year is about a 25% year to date. And this month, we are about a 1.1% month to date. Here, you can see the shorts and the longs, right, that the system is taking, the profits, the wins, and the losses, right, and both. And here you can see auto trading data from different subscribers. So you can see the subscriber are Interactive Brokers, how they are trading the system. If you have any question about the specific models, please contact me and I will be more than happy to help you. Overall, and to conclude, this has been a very good year for the equity markets. It could change in the future, but so far I think that the economic view, the global macroeconomic view, is very strong, and this is not likely to change soon. We could see drops, significant drops on the market. As you can see, the S&P 500 in a monthly basis, right? It's near the channel. Nasdaq in a monthly basis is at the channel. The Dow Jones in a monthly basis is above the channel. We could see retracements, and it would be healthy to see retracements. Volatility is extremely low. We have never seen this value here, right? The all-time low. We could go to quarterly basis since the beginning of volatility, and you can see it stays low for a period of times, but no for many years. So here I did it from 2003 to the beginning of 2000. So 3 years. We already been 1 year and a half. So we'll see for how many more quarters the volatility keeps trading lower and lower. Okay. And just this part here, European managers think American equities will outperform European equities, and American managers vice versa, right? They think that European equities, at least, they have more potential, right? So thank you so much. And like always, any question, just write on the comments here on the video. Just contact me by email. Thank you so much, and have a great 2008 trading. Bye bye.